Sumitomo Chemical India is poised to deliver industry-leading performance. In the domestic market, which forms about 70% of the revenue, Sumitomo is aggressive on new launches both in generics as well as proprietary specialized products and is also strengthening distribution, aiming for leadership position in the Indian market. Furthermore, exports have huge growth potential given the parent as well as sister companies spread worldwide, strategizing to reduce sourcing from China. Huge portfolio of specialty products and strong innovation record of parent company gives Sumitomo an edge, providing huge potential for growth. And therefore, it's among our preferred picks in the agrochemical space. Sumitomo is focusing on new launches to drive growth. It launched one insecticide, one metal phosphide and two plant growth regulators in Q1 FY23. The company is putting greater focus on high growth and profitable segments such as herbicides, plant growth regulators and biorational products. It's also increasing focus on fruits, vegetables and the paddy segment. Its R&D team is also working on several off-patent products as well as pre-mixture combinations to be launched in both domestic as well as export markets. Recently, Sumitomo took 2 additional land parcels for capacity expansion as well. The first land parcel of about 20 acres is adjoining the current manufacturing plant at Bhavnagar. Also, it has taken about 50-acre land parcel at Dahej. It's aiming for market leadership position in India, like I said, and significant ramp up in exports backed by support from global parent. Parent company Sumitomo Chemical or SCCL is the third largest agrochemical company in terms of patents, which highlights its focus on R&D and innovation. It spends about 10% of its revenue on R&D. Now, to reduce dependence on China, SCCL as well as other group companies worldwide plan to source technicals from Sumitomo Chemical India. It has received in-principle approval for 5 products and will be investing 120 crores to manufacture these products. It expects revenue potential to the tune of 200 to 250 crore rupees. Commercial production for the first product is expected to commence in this fiscal itself. The company has indicated that it's in talk with parent SCCL and group companies for supply of additional products as well. Now, apart from supply to the parent, it sees scope for enhancing supplies to group companies in key markets the likes of Africa, Latin America as well as Europe. SCIL posted among the best results in the agrochemical space in June 22 quarter. Revenue grew strongly by 26% year-on-year. Growth momentum was led by exports with revenue doubling on a YOY basis and share of exports increasing to 20% of the revenue compared to 13% in Q1 of FY22. Domestic revenue grew at a healthy rate of 16% YOY. We believe growth in the domestic market was led by pricing, as delayed rainfall would have led to slower volume growth. The share of specialty chemicals in the overall revenue mix remained constant at 25% year-on-year. SCIL's gross margins declined by 100 basis points YOY owing to increase in raw material costs. However, operating leverage owing to strong top-line growth enabled SCIL to maintain EBITDA margins on a year-on-year basis. Owing to delayed onset of rainfall, there could be some spillover of sales in the domestic market to Q2 FY22 from the preceding quarter. However, we need to be watchful of the domestic market volume growth in the second quarter owing to deficiency in the sowing of paddy as well as pulses compared to the same quarter last year. With overall rainfall being 7% above the LPA at the national level, water levels in reservoirs have increased, which would be supportive for the upcoming Rabi season. On the raw material side, crude prices have corrected by more than 30% post the Russia-Ukraine crisis at the end of FY22, which would ease the raw material pressures witnessed from the start of the current fiscal. However, there could be some impact of high-cost inventory in Q2 and we would be watchful of that. Overall, SCIL has strong potential owing to healthy launches in the domestic market as well as the potential to significantly ramp up exports to parent as well as group companies spread across multiple geographies. The stock is trading at 43 times its FY24 projected earnings. While it is trading at a premium to other agrochem players, the higher multiples are justified given its healthy balance sheet, R&D focused parentage and huge growth opportunity in export markets. Therefore, we recommend investors to utilize the market weakness to add the stock to the portfolio.